Good morning. Very much welcome to Finanspanelen. My name is Pehr Wissén. I work at the Swedish House of Finance at the Stockholm School of Economics, and together with SNS we are arranging this seminar series. And this particular seminar today is part of the SNS Digitech Forum, which is a seminar series on the digital economy funded with support from Vinnova. And we gratefully acknowledge the support from Vinnova in doing this. And today we will talk about Bitcoin and blockchain. I always say wrong. I mean blockchain, I say Bitcoin. The words are so similar. Blockchain. And I don't know about you, but for a long time I struggled to try to figure out what it is and how it can change society, if it can change society, and sort of the importance of it. And so sometime earlier this year, a friend of mine said to me, go to YouTube and look at 3 lectures by David Yermack from New York University. Then you will understand. And I did, and it changed really sort of my whole perception of what blockchain can do and sort of the importance of it. And I learned a lot, and I thought we must find a way to get David Yermack to come to Stockholm to explain this to us. And here he is. And we are very happy to have you here. David Yermack is a leading expert on financial innovation, blockchain technology, and the impact of financial services. He's professor of finance and business transformation at New York University Stern School of Business, and his research areas include board of directors, executive compensation, and corporate finance. And he teaches courses on, among other things, Bitcoin and cryptocurrencies. I hope I got that right. And today we will do this the academic way. You know, when non-academics talk, they want to talk uninterrupted, and then there is time for questions. Academics don't mind being interrupted. On the contrary, that's how they like it, to have an interactive dialogue. So I will be quiet from now on and sit there, and if you don't understand what David is saying or don't agree or want to hear more about anything, just raise your hand and then wait for a microphone. We have people running with microphones, and tell your name because this is being filmed. So you need the microphone so we can hear what the question was. And David will answer it. So with these words, David Yermack, we are very happy to have you here in Stockholm. Please, the floor is yours.
Okay, thank you. Okay, thank you all for coming out in such large numbers today. This is not my first trip to Stockholm. I've been coming here off and on for many years, and in 2005 I spent an entire semester as a visitor at the House of Finance and the Stockholm School of Economics when I was on sabbatical from NYU. So I've made a lot of friends here, and one reason to come here these days is because Sweden as a country is one of the most technology-forward nations in the financial services area. I think you all probably know that the use of cash is lower in Sweden relative to electronic payments than probably any other country in the world. And your central bank is already looking at a national digital currency, the so-called e-krona. And there are many interesting things going on here in areas such as the National Real Estate Registry and in the banking sector and so forth. So Pehr said I was an expert in this field of digital currencies, and this is almost by default because it has taken academics a long time to view this as a legitimate research area. And I've been doing this for the better part of 4 years now, since late 2013, and this makes me I guess one of the academics who studied digital currencies and blockchains longer than almost anybody else. And this is an area that has grown now very quickly. And we're now offering, honest to God, 11 courses in the fintech area at NYU. We're trying to become a destination school and the leading school in the world for this. And there's enormous interest, especially from students, but even more so from employers, because what is happening is that the job market for graduates is changing very quickly, and skills in the data area are just basically much more important in the job market than they've ever been before. So I want to give you an introduction to some of the important topics. And it's useful to start with a comparison that I show our students in New York, and they already kind of know this, but this is the trading floor of UBS, one of the big banks 12 years ago, and this is the same trading floor today. And it's not that there's any less trading going on, but the way it's being done is not by people anymore, but there's probably a few banks of computers over in the corner. And this is just one small field of fintech, but this is what's happening to the finance industry. And there are far fewer jobs, and the ones that exist today are much higher value added in that you have sort of one data scientist doing the work of what used to be 3 or 4 traders or portfolio managers. And this particular episode is not due to the blockchain itself, but I think of all the innovations that have come into the area, this is probably the most profound and will have the longest reaching consequences. So this article is a cover story from The Economist magazine that ran 2 years ago in October 2015. And I think for people looking for a general introduction to the topic, this is not a bad place to start. So I assign this to all my students, and you can just download this on the web. But famously, they called the blockchain a trust machine by way of explaining what it is. And it says at the end of the slide here that the blockchain lets people who have no particular confidence in each other, total strangers really, it lets them collaborate without having to go through a neutral central authority. Simply put, it's a machine for creating trust. And what a blockchain is simply a database, but it's a database that's organized very differently than the kind that you've probably dealt with in your jobs and in your personal finances before. And it's a way of people making economic transactions without a middleman. So without a bank or a credit card processor or any other clearinghouse coming between them, and doing so in such a way that they have full confidence that there will be value where people say there is and so forth. So typically we place a huge role on these trusted third parties, banks and other payment processors, to certify and guarantee and stand behind transactions. That's the very nature of the banking industry. But the claim is here that you have a database structured in such a way that you no longer need that. And the implications of this are pretty serious, that there are many, many millions of jobs of people who keep track of things and move them from one ledger to another and audit them and so forth. And if this technology lives up to its potential, many of those things will no longer be needed in society. Now, this will make things cheaper, more efficient, and so forth, but also cause many people to have to change their careers and have very different implications for what universities should be teaching, what companies should be trying to hire in the job market, and so forth. Now, there's been a lot of talk. You read these stories in the press, but people are wondering, when are we actually going to see this? There's a lot of hype about the blockchain. And I want to start with just 3 recent examples to show you that it's already here. And this is really moving much faster than I expected. And some of the biggest organizations in the world, names like Daimler-Benz that you would recognize immediately, are beginning to implement this. In this case, Daimler, back in June, just 3 months ago, issued 100 million euro worth of corporate debt on a private blockchain that they just ran from their headquarters. So this was kind of a first of its kind transaction, but it worked very well. And it showed that to raise capital in the debt markets, you don't really need an underwriter or an investment bank. And so, that industry may be gone soon. I think in supply chain management and logistics, you may find the biggest opportunities. If you ask me what's the killer app or the biggest footprint that the blockchain may leave, I think it may be in situations like this. This is an article about Maersk, the giant shipping company that does all the containerized freight around the world. And they have implemented in the port of Rotterdam a huge blockchain operation to track goods in transit. And this is interfaced with things like the release of liens and collateral that are attached to goods as they move from one place to another. The vendor for this is Microsoft. I mean, these are very, very big players who are making prominent investments in the technology to address problems that in many ways are age-old in the shipping business. Here's a very recent article about the French insurance company AXA. They are using the Ethereum blockchain to sell flight delay insurance. I'm not sure why you would want to buy this, but there's a market for this. And if your plane is delayed more than 2 hours, there's an insurance policy that will pay off. And they've automated this on the blockchain so that the contract automatically executes and makes payment by merging with flight delay data and so forth. This is just one example, but it's a representative case of what we call a smart contract, where you essentially program a database to move money around based on some contingency. And again, you don't need the third party. There's no insurance adjuster or person who certifies the transaction. It all occurs just mechanically in this case if a flight delay happens. So these are very recent examples, and I picked them because the companies are so well known. That, the point I want to make is that many of the very biggest finance and insurance companies in the world have embraced this technology and are moving pretty rapidly to integrate it into their operations. Now, what's motivating people? The finance industry worldwide through history has not met people's expectations. And there's plenty of evidence that we really should be doing much better. I'll show you basically 2 slides, although I could go on for hours with all kinds of data about how bad a job banks do and so forth. And I'm not really picking on any one bank so much as the structure of the industry itself. So a colleague of mine, Thomas Philippon, did a very ambitious research paper where he constructed a time series of the cost of financial intermediation going back to the 1880s. So you have 130 some years of data. And by financial intermediation, we really mean the cost of clearing a check or processing a credit card transaction. Or these days it would be an electronic payment on Swish or something like that. And if we go back 130 years, the cost of this was 2%. And today it's still 2%. And there have been vast improvements in data processing and communications. And, it really should have internalized itself into the industry by now. But what's happened instead, of course, is that the compensation of bankers has gone up astronomically, but the benefits to the consumers have been, in 130 years, absolutely nothing. And there's no other industry that has stayed in the 1880s cost structure that I can think of, but banking has managed to do this. What about the stability of the system? I don't think we need to spend a lot of time on this, but this is what a bank run looked like in 1873. This is what it looked like in 2007. It's in color now, but it's the same problem. It's never been solved well. The system, is notoriously unstable, where we have this deposit insurance scheme with moral hazard, and banks fail all the time, and taxpayers pay trillions of dollars. And you guys know the story. So there's got to be a better way. And it now seems that a turning point took place about 8 or 9 years ago. And at the time, it was not noticed by many people at all. But somebody, and we still don't know who this was, but somebody calling him or herself Satoshi Nakamoto posted this white paper on a cryptography bulletin board somewhere on the internet. And it attracted interest from a small group of specialists in the area, but word of mouth spread, and volunteers helped code up this proposed project. And Bitcoin, as it was called, went live on January 3rd, 2009. And Nakamoto represented this as a peer-to-peer electronic cash system. And this was really the first implementation of a blockchain on a scale that drew in many users. And it took a while to get some traction. The first actual payment of goods and services with Bitcoin wasn't for another year and a half in May of 2010. But I think, as you all know, this thing has grown and spread into society and culture with astonishing speed. So for those who don't know, and I suspect most of you already do, but what Bitcoin is a currency that is very different from others that the world has seen before. So for one thing, it's not issued by a government. So this is a stateless currency that is just issued by a worldwide computer network. And it's decentralized in the sense that nobody is in charge of it and there's no central server. Instead, it is distributed on about 10,000 nodes that exist basically everywhere in the world. And even if half those nodes are attacked or go down or whatever, it would continue to run on the others. So there's There's really no way to pull the plug on this. And it's algorithmic because it's governed purely by mathematics. So there's no central banker. Nobody changes the rules or adjusts monetary policy. When this was launched in 2009, the creators just stipulated a set of rules and procedures, and these have basically remained intact and I think will continue to be intact as long as this thing runs, which could be for hundreds of years. There's no physical Bitcoin. It's simply computer memory. So again, unlike other money, which you can hold the physical currency or take it home, put it under the mattress, this exists only as an idea. And some people have said Bitcoin is the greatest practical joke of all time because you put out this code and people start running around and treating it like it's valuable. But there's no question that this has made a mark on economies around the world. And the easiest way to tell this is by what price it trades for. You've had exchanges that have been open for more than 7 years trading Bitcoins like other financial assets. And originally they traded for 5 cents, for a nickel. Recently, a Bitcoin has been worth, I checked last night, it's about $4,100. So had you bought this at any point in the past, even a month or two ago, the rate of return has just been astonishing. And as I think you all know, there have been many imitators. That today we now have 1,100 digital currencies, and more are being created all the time for different uses. But the whole asset class is worth somewhere north of $100 billion. And some of the other names like Ethereum and Ripple have now become very commonly known in the business community. And it's a totally new idea about having a cryptographic asset, but it looks like an innovation that is definitely here to stay. But it's not the Bitcoins that's really the great point of interest here. It's the technology behind it, the blockchain, that makes it work. And what I really want to do is both give some examples of this, but also work through how a blockchain is put together and give some idea of the versatility for other things it could be used for in the future. So here's an article from the Wall Street Journal about UBS, and I pulled out a couple of quotes. It says it's increasingly been eyed by mainstream financial institutions as a breakthrough. And I think this is clearly correct, that everybody's looking at this and thinking about how to use it in their organization. And it can enable them to settle trades in seconds rather than in 2 or 3 days, which is what it now takes on the New York Stock Exchange, amazingly. And they estimate that blockchain technology could reduce this bank's infrastructure costs by as much as $20 billion a year within 5 years. Now, that's a lot of cost savings in one company. And if there's maybe 50 banks in the world the size of UBS, that's $1 trillion in cost savings. You know, you're talking about numbers on a scale that you rarely see. And this is in a very serious publication that doesn't, play jokes on its audience and so forth. And this is one thing I've had to get used to in this area, that when you see estimates of the potential value of this technology, people throw around numbers like trillions. I've even seen quadrillions used at one point. And this is just on a very different scale than I've ever seen for estimates for any other technology, any other savings and so forth. But implicitly, where are these savings going to come from, of course, are jobs. That, the idea here is that you really won't need banks in the future. And we may not need stock exchanges anymore. Or if we have them, they may be greatly reduced and catering maybe to what we call legacy clienteles, which is like older people who aren't comfortable with the technology, but these will eventually disappear as well. Things like government property registries. There's all kinds of databases in government for real estate, automobiles, immigration data, healthcare data, and so forth. And all of this, in the long run, might migrate to blockchains that require far less oversight by the government and so forth. And again, you're talking about many, many jobs that people have. Accountants are totally unnecessary with this technology. This is like a self-auditing database. And so, people who work for Ernst & Young or Price Waterhouse, not anymore. And lawyers,
there will always be lawyers, but there may be a lot less of them. Once we have these smart contracts that automatically execute themselves and so forth, I think there will be new legal problems that they cause. But many of the things that lawyers have been doing for a long time may become unnecessary. Now, some of this is utopian, and many of these predictions will probably take longer to come true than people imagine. But I think others will happen more quickly. That things like international payments over the SWIFT network, I doubt will be continuing even 2 years from now, given that alternatives are being put into place and so forth. So you can really look at the behavior of the firms in the industry to get a sense of the impact of this. And this is a timeline. It shows when certain well-known organizations made their first public announcements that they were doing trials or research in this technology. And the big cluster of companies that really kind of got over the denial and began to look at this seriously was in the fall of 2015. It's about 2 years ago. And you see especially all the payments processors in here, MasterCard and Visa, American Express, and so forth. But there's also insurance companies, investment banks, commercial banks, and so forth. And pretty much every financial organization in the world at this point is looking at what they can do with blockchains. And what's motivating them is pretty much the same thing, which is fear. They realize that this is an existential threat to what they do. And I think what you're seeing in industry is a furious race to co-opt really the bare minimum of this technology to preserve the position they have in the market. But in the long run, I think the recognition is very obvious that these are organizations that may have passed their use-by date, that we really may have no role for them in the next generation in the economy, and they're trying to stay relevant. And I think we're going to have an interesting period where they try to get the regulators on their side and to create barriers to startup firms moving into industries and so forth. This may work for a while, but in the long run, I think it's probably going to be futile. So I'm going to just quickly go through some product and service announcements that have been made around the world just to give you an idea of the range of applications, and then look in some detail about how this actually works. So stock exchanges almost everywhere are now looking at this as an alternative for the clearing and settlement of trades. And I mentioned that in New York, in the 21st century, it still takes 3 days. They're, I think, switching now to a 2-day clearing, but it's embarrassing. And in Australia, the ASX, the Sydney Stock Exchange, made this announcement in January of 2016 that they were going to switch the whole exchange over to a blockchain platform. And at the time, this was a real blockbuster. It was unexpected that anyone would move so quickly. And this was like a real stock market in a real country, with a lot of capital behind it. And at this point, the issue is really not if this is going to happen, but who's going to be first. And I don't think it's actually going to be Australia, simply because other countries are passing them. And in New York, it's decentralized, but we have a clearinghouse called the Depository Trust Clearing Corporation, and they are switching to a blockchain. And Frankfurt, Tokyo, there's a long list of stock markets that are in some way going to integrate this technology. I mentioned before supply chain management. This is the largest mining company in the world, BHP Billiton, which digs up a lot of iron ore in Australia mostly, and then ships this mostly to China. And it passes through 30 different hands in transit of different subcontractors and shippers. And in the past, these people have kept 30 different ledgers. They've all had incentives to lie about when the goods arrived. And, all kinds of record-keeping problems have complicated the movement of goods. So BHP has implemented a blockchain solution where everybody goes against a single ledger. And collateral that is posted by banks is automatically released as goods change hands. And people can't really lie about when the ship came into port or when the delivery truck arrived, because both sides have to record, and there's a central ledger that everybody's monitoring. So this is similar to the Maersk example, and this is just a huge, huge industry of movement of goods in transit. This is IBM's effort in Manhattan. They have opened something called a blockchain garage, which is one of these lofts where people don't wear suits and they're allowed to come and go as they please. And I think they're not allowed to talk to the other people at IBM. It's one of these units that is subversive and trying to ruin the business of the rest of the company. But this article in the New York Times talks about how they have 400 clients testing this, and these are people like Walmart, the biggest retail company in the world. They had 650 staff working on this as of earlier this year, and I think the number today I recently read somewhere north of 1,000. And these people, for us, are very accessible. They're walking distance from our campus, and so we've had them in for seminars and so forth. Most of this industry, or maybe not most, but the center of gravity is actually in New York. And this is a little different. It's not Silicon Valley or some of these other places, but I would say New York, London, and in the Far East, maybe Singapore would be the centers of this. But Stockholm is one city where you certainly see a lot of innovation and use of cryptocurrency as well. You can use blockchains to certify the authenticity of luxury goods. So I've spoken at a conference in The Hague where they had art detectives, Interpol, and people like that trying to create an international database of museum and gallery holdings. I think that's a very good application, but the real customer for this is people like Louis Vuitton who want to authenticate handbags and make sure so a customer knows that they're not counterfeit and so forth. So this whole field of provenance, as it's called, seems like it's ideally suited for this, and you have a lot of startup companies moving into the area with different product offerings. Central bank digital currency, I think, is coming. And this is the Bank of Canada, which is experimenting with a digital dollar on its own internal blockchain. I think in a generation, you're going to see all the central banks move the national currency to some electronic form, likely on a blockchain. And this will make the fractional reserve branch banking system unnecessary in the future because everyone will just have an account at the central bank on the national blockchain. It's a very different financial system, but everybody's looking at this. And you have lots of other unexpected applications, such as energy. This is a company called Power Ledger in Western Australia, but this has been replicated around the world where you have neighborhoods where everybody has a solar panel on their roof, and rather than selling the energy back to the grid, they just sell it to each other in the neighborhood, and you have something called a smart grid that keeps track of who's buying from who. This is very environmentally friendly because the energy doesn't dissipate over the long distances that it would if you sold it back to some central node. And it makes you reconsider the role of the utility. The power company is really the middleman, just like the bank in the payment system. And if you can do peer-to-peer energy, which is what's being attempted here, we may not need electric utilities either in the future, or at least far fewer of them with a much smaller role in the industry. So, we could go through many, many of these, but people's imagination has brought this technology into a wide range of applications that goes far beyond finance. Now, I think fundamentally what we're talking about here is the new peer-to-peer economy that you've seen in a number of different settings. And for me, the music industry is a very useful point of reference. The Napster file sharing service, which came online in the mid-90s, changed the music industry profoundly so that for the user, you can now get music online at a vastly lower cost. Did you ever have these record stores in Stockholm? I'm sure you did, right? And they're gone now, right? And what's happened in this industry is that revenue has dropped by about 2/3, but people are listening to more music than ever. Now, who's worse off is the whole infrastructure of middlemen and third parties that were distributing the music before. Today, the two giant companies in this paradigm would be Uber and Airbnb. Airbnb is the largest hotel company in the world already by room nights. Uber has totally changed the taxi industry. In fact, it's created a new industry called ride sharing that has expanded demand greatly for this. And it's raised the question of whether people will even own cars in the future in a city like this, or just Uberize all their transportation. So both of these companies have value somewhere north of 60 or 70 billion US dollars, according to the price that people are paying to invest. And what's interesting is that neither of them has gone public on the stock exchange. And this is unusual that at this stage in a $60 billion company's history, you would almost certainly have listed your shares on the market and become a public company. I think both of them are actually eyeing blockchain equity issuances, that there are many firms not yet public who arguably should be, but are looking for alternative ways to list their shares in the future and deliberately bypassing the stock markets that we have now. So in the payments area, which is really where the blockchain has come of age and gotten the most attention, you've had a progression that I think PayPal is a useful point to start thinking about this. PayPal is a service that allowed two people to send money directly. It's been around for about 30 years. And there have been many derivatives of it. One of the more interesting is in Africa, which is a service called M-Pesa that was begun in Kenya and has now spread to many other countries. With M-Pesa, you have essentially currency denominated in minutes of mobile phone time. And in Kenya, you have a country where there's an educated urban population, but most of the country living remotely in villages without access to the banking system. But it turns out all these people have mobile phones. And so what you do with M-Pesa is if you're living in the city, you put minutes of time on your phone and then send them to your parents in the village 1,000 miles away. They can then spend them or cash them in. It's basically a money transmission service. And what you've seen are telecom companies, in this case Vodafone, registering for payments licenses and basically competing with the banks in a way that the banks never expected. So the big innovation is Bitcoin, and the real difference is that you can't identify a middleman. So with PayPal, you've got the credit card companies clearly using this as an interface. And with M-Pesa, you've got Vodafone. But with Bitcoin, you have just a process that is called consensus, where people, if the cryptographic codes line up the right way, don't need Vodafone or MasterCard and Visa. They're simply willing to trust the process as opposed to a third party who comes in between. I'll get into this now. I just want to recall one story. I met someone from Kenya, and he stopped me. He saw a T-shirt I was wearing, and he wanted to talk about M-Pesa. And I said to him, this makes Vodafone into the central bank of the country because M-Pesa is used by 60% of the population. It's a serious competitor to the banking system. And he said, we trust Vodafone more than we trust the real central bank. That's the point. And I think that's really what's playing into Bitcoin, that this thing couldn't have been launched at a better time. It was created in 2009, right at the bottom of the financial crisis. And it catered to a worldwide audience that was just really frustrated with the regulation of the banking system worldwide. So just as people in Kenya are more willing to trust Vodafone than the banks, there was an audience for something like Bitcoin that cut the banks out entirely. So how does the blockchain work? It's not a new idea. It was actually proposed in 1991 by these two scientists at Bell Laboratories in the U.S. And the problem that they were trying to solve was to authenticate intellectual property. So if you read their paper, and it's written for a broad audience, you can download this and take a look at it. But they say that in today's world, there are many forms of property that are essentially virtual and not physical. So a track of music, an essay published on a blog on the internet, anything that is essentially bits and bytes where somebody wants to claim authorship has a problem in that other people could copy the file easily and then say, I wrote it. And so they propose a way of arranging the data on a database that they don't actually use the word blockchain, but it's their structure that ultimately gets co-opted by Satoshi Nakamoto into Bitcoin. So this is 17 years later. The blockchain of Haber and Stornetta was well known by cryptography people, and they actually tried to commercialize this, and I think they were basically ahead of their time. But Nakamoto took this structure and built it into a payment system. So rather than using it to authenticate intellectual property, he's going to use it to authenticate money. And if you look at what goes into the Bitcoin blockchain, this is a representative cross-section of the data, and you've got 5 transactions. You would read this from the bottom up because you can see they're time-stamped in sequence. And the data is completely unsurprising because it is what a bank would use in its ledger today. So you have basically the source that is going to send money to somebody, and then the destination, the recipient, and they both have digital addresses. These are actually 64 characters long. They've truncated them, but they represent what we call digital wallets, which are sort of the same as accounts on this exchange. And this is simply the number of Bitcoins held in the wallet and the number that you want to send to the next destination. And so you see them moving up a line to here. And you have to authenticate the transaction by signing it with something called a private key, which is similar to a password. So your address is called a public key, and this is given to everybody, anyone who you wish to have money sent to you. So if it's a store, they would post this right by the register. And the private key of the sender will match its own public key in a certain way that would release the coins to the next person. So this is really what's being trusted, is the cryptography where somebody provides the correct private key to match the public key and then gives the next user the permission to take the asset. And then the next person sends it to the next one. In this case, it's passed through 5 different hands. Now, the way this data is actually stored, and this is on the 10,000 nodes around the world that I referred to earlier, is they put it together in blocks of size 1 megabyte each. So each block, at least until very recently, has been of a fixed size. And a typical block on the Bitcoin blockchain has about 1,500 transactions where person A sends money to person B. Now, they've drawn it here in a simplified form. And so there's simply 4 transactions here, but you could keep going and have a couple thousand perhaps. And each of these, A, B, C, and D, are just like the ones on this list, where John Smith sends to Joe Bookie and so forth a certain number of Bitcoins. Now, what do you do with this data? You apply something called a hash function. So H of A, H of B, and so forth are turning the input data into what's called a hash code. A hash code is a combination of letters and numbers, 64 characters long. And it's a way of encrypting data that is widely used in other settings. A hash code basically has 2 important properties. One is that if you change the input even a little bit, so add a 0 or a decimal point or something like that, the hash code is thrown off completely. And the fact that the input data had been changed would be obvious to any person. The second thing about a hash code is that you can't invert it to get the input back. So if I give you a long hash code, you can't figure out what created it except by brute force trial and error. And that is something that would take even a supercomputer a very long time to do. So data is impossible to change in the sense that you can't look at the hash code and figure out what is behind it. And if you even could, you would change the hash code in a way that would be visible for anybody looking at the ledger. So what you do in these blocks is you hash all the input data, and then you can take 2 hash codes and hash them together into one. And so that's what's on the second level, is that you're combining and essentially condensing the data, and then you take these 2 and you hash them together. In the case of a block on the Bitcoin blockchain, you might have 1,500 or even 2,000 transactions that are eventually folded into one 64-character root. So this is called the root of a tree. It's an extremely efficient way to store data. And what it allows you to do is to make sure that nothing has been changed, because if somebody changes transaction B, that will change the hash of B and then the joint hash of A and B together and all the way up the tree, so that you could look at the root in the block and understand not only that something had been changed, but you could trace down exactly where the change had occurred. So when I said that we don't really need auditors in the future, this is very different than the kind of journal that you might have at a bank where somebody erases and then puts an extra zero, and you hope that Ernst & Young catches this, but maybe they do, maybe they don't. Here, it's plain as day. And even the auditors realize that this is something that puts them out of business. Now, the key innovation, the chain, is that we're going to take these transactions in a block, and we're going to add one more thing, which is the previous block's hash. And so what you have here is a very simple blockchain with 3 blocks, 0, 1, and 2. And each has this root of data, but you then take the block and hash it into the next block as an input. So what that means is, again, if I change B, it's going to change everything internally to that block, but it will also change the hash into the next block. And so not only will block 1 be off, but also block 2, and everything forward from that point. So it's a way that exposes immediately any change to the underlying data to anyone who's able to see the blockchain. And this could not be more different than double entry bookkeeping that's been used for 600 odd years. That this is something that is a self-auditing technology that is just a huge innovation. I've, in many lectures, compared the blockchain to the advent of double entry bookkeeping, in fact. That if you think about how commerce changed before and after that type of record keeping arrived, I think we're looking at a similar point in financial history where there's suddenly a better way, a real innovation in how to keep financial records. And what it's going to do is change the role of banks and all the people behind the system irreversibly. So this is another view of the same data, that you have these transactions, but you have the hash of the previous block. And that's the chaining together, is the fact that you hash one thing into the next, and you're essentially recording data sequentially. And if anyone goes back and changes any one transaction, it throws off the entire chain in such a way that people can see it. Now, a very key question is who actually gets to see the blockchain and to update these blocks. Because if it's just one bank and it's hidden from view, it's not clearly going to change anything, and that you're relying on that bank and you need to watch it and so forth. So these creators of the blockchain, Haber and Stornetta, pointed out that the role of the trusted third party is very critical, that the person updating the blockchain ultimately has to be themselves monitored. And so they proposed a further idea, which is called the shared ledger or the distributed ledger, meaning that you would give a copy of this to everybody who's a customer on the network. So that not only would the blocks change, if you change this transaction, it would throw off the next, but everybody would be able to see the change. And there's this picture that's been circulating on the web. This is the financial system we have now, where you've got, say, 4 stockbrokers, and they all go against a central clearinghouse where there's one copy of the ledger and the clearinghouse updates it. The new model would be to give everybody a copy of the ledger and let them trade with each other, and you wouldn't need that authority figure, the clearinghouse in the middle, to keep the master ledger. Instead, everyone would share the ledger and, in this view of the world, have the responsibility for updating it. This is why you don't need the stock exchange anymore, because what it does is keep records and so forth. And so cutting out the middleman is really the central logic of this. Now, Nakamoto took this one step further, and in many ways this is the cleverest innovation of Bitcoin. That rather than have a trusted third party, like him or her, be the person updating this, he decided to start a contest. And so on the Bitcoin blockchain, and in fact most of the cryptocurrencies have the same design, every 10 minutes there's a contest of anyone who wants to enter. And so anyone here, if you wish, could boot up your laptop and join in. And there's a reward that currently is 12.5 Bitcoins for whomever can solve the block and add the next block to the blockchain. And at $4,000 each, this is about $50,000. This is something that people are interested in. Now, how do you do this? What you have to do is, This is the same scheme as before in that you have the root of transactions and you have the hash of the previous block. You have the timestamp at which point the block was made. There's one more thing that goes into the Bitcoin blocks, which is called a nonce. A nonce is a random number that can be discovered only by trial and error. And it has the property that when you add it to the other parts of the block, it generates an output hash below a certain critical value. And these days, the critical value begins with 17 zeros. And you can only find this by essentially guessing integers, one after another, such that you finally discover a nonce that will create the right hash function. This takes trillions and trillions of guesses. And what you now have are people around the world in bunkers doing what is called mining Bitcoins. These are the people keeping the books, and there are thousands of them around the world in a race every 10 minutes to try to solve the block and update the ledger. So these are the people who are replacing the work of the accountants. And this is sometimes called competitive bookkeeping because it's a contest between accountants every 10 minutes. Now, you can do this at home. You can start guessing random numbers on your laptop and take the feed from the Bitcoin network and hope to complete the block. But you're competing with these guys because there's so much money in this that it pays people to buy these specially designed circuits by the thousand and put them in bunkers. This one's in Iceland. And why is it in Iceland? Because you get free energy from geothermal power bubbling up from the earth. The key input to this is electricity to run all these circuits. And people have tended to locate these Bitcoin mines in places like Inner Mongolia, Venezuela, and so forth. These are places that, for strange reasons, have free electric power. In Venezuela, Maduro gives it away. The great dictator wants everyone to have free electricity, and so they do, and the Bitcoin miners join the party. And in Inner Mongolia, someone built a hydroelectric dam without permission, and they weren't allowed to hook it up to the grid. So instead they said, well, the Bitcoin miners may pay us for it. And so all the Bitcoin people moved to Inner Mongolia. This is obviously not going to continue forever, but it's kind of fun that you've get these Chinese people who all become Bitcoin miners and collect these rewards, but they're doing something that is identical to what a data center at Barclays would be doing, right? These guys are processing transactions, blocking them on the blockchain. They enter and exit the industry based on supply and demand and signals from not only what's the price of the reward, but how many other people are trying to mine at the same time. Bitcoin's software adjusts the degree of difficulty so it always takes 10 minutes. So if someone builds a giant bunker and starts to solve the blocks quicker, what you get is a higher degree of difficulty, that you have to search harder for the right nonce. And every 2 weeks, the difficulty is reset to calibrate the problem as a 10-minute cycle time. So it's a design choice, and other blockchains do it differently. So the Ethereum blockchain, which is the second biggest, does it 5 times a minute. So every 12 seconds is the cycle time there. And there's different trade-offs that you make in doing this, but you've got really a genius system where capacity for processing the payments is these people can actually shift between blockchains, and they do. But it's done in a completely decentralized way based on signals from the marketplace. Now, how will these miners behave? Are they going to collude and subvert the system? It turns out that it pays to be honest in this system, which is one more clever part of it. This is a scheme where you've got a blockchain and these blocks are in sequence, and let's just say someone wants to steal a transaction by rewriting block 74. So you say, rather than send the Bitcoins to that guy's digital wallet, send them to mine instead. So if you had a really fast computer, you could change the data and you'd have to solve that block again by discovering the right random number. And in theory, you could do this, but if everybody else is working on this block, 17 blocks ahead, you have to solve not only this block, but all 17 blocks intervening. In other words, you really need a computer 17 times faster than the next fastest computer. Now, what if you actually had that? You could start stealing and rewriting transactions through history, or you could play for the reward on the, you could be honest and then win every block going forward, at least for the indefinite future. And the reward for being honest is going to be much higher because if you did start subverting the network, the market value of the currency would quickly drop and so forth. So internally, this actually works to give people incentives not to be crooked, but to actually do the honest work. That if you happen to have an advantage over any other computer, you want to basically enter the contest against them and collect the reward. So I think you guys give the Nobel Prize in economics every year here. And there's been talk that Nakamoto would be a good candidate for this. I think the problem is nobody knows who it is. And it could be a group of people. I think someday we'll probably know for sure. In the meantime, I might suggest these guys. Haber and Stornetta, who first suggested this, I think they have a real profound innovation here that has the potential to leave a footprint across the economy for years and years to come. Now, you guys haven't asked any questions, and I think I'm going to stop in a minute and open the floor. But let me point out that there's a fundamental tension that really the point of contact of this technology with industry takes two forms. One is this open blockchain model that I've been describing for Bitcoin. So this is a network that absolutely anybody can join. There's no barriers, no financial exclusion whatsoever. There's no central governance. It's completely decentralized by code. The size is endogenous in the sense that it grows and shrinks really based on supply and demand. And the blocks in the blockchain are created in this contest every 10 minutes where people around the world are competing to update the books. The alternative is the so-called permissioned blockchain. And I've put the logo of the Australian Stock Exchange just as a representative example. They're proposing to change their stock market to a blockchain market, and they may do this as soon as next year. But they would be the trusted third party. They would decide who can participate. They would be the gatekeeper and collect the monopoly fee from everybody who's allowed to enter. They would control the size of the network, and they would update the blocks. Now, it's a very different model. In fact, this is what I talked about before, that the ASX is clearly trying to recreate its own role as the gatekeeper and the person who arbitrates disputes and collects fees from everybody. Will they get away with this? I think in the short term, they probably will. That you're going to see many of these so-called permission blockchains popping up in industry where they are able to do the job they've been doing more efficiently because the blockchain saves you a lot of money. But in the long run, there's this other model out there where you don't have any third party at all. And I think the advantages of this are so much greater that it will eventually displace all of these intermediaries. But it's going to be brutal, that these people obviously will fight to the end and try to get the regulators on their side. And what's happening in industry now are what are called consortiums. So here's just two examples that in the banking industry, there's about 70 of the major worldwide banks cooperating in something called R3 CEV, which is something in New York that's developing 20 blockchain platforms, give or take, to trade assets like credit default swaps, consumer loans, and so forth. There's other consortiums such as Hyperledger and the Ethereum Enterprise Alliance and so forth. But these look a little bit like cartels. And what they represent are attempts by industry to co-opt this innovation, but keep the same kind of barriers and exclusions that they've had for many years. So in the accounting industry, there's a consortium among the 4 big accountants that are, trying to do the same thing, to create, reasons for them to continue to exist and to exclude upstarts and entrants. These things, I think, will work for a while. And you're going to read about them in the press, but in the long run, you have a contest between 2 visions of the future. One is completely decentralized with anarchy, but a heavy use of incentives and competition. And the other is kind of the old system dressed up with the bare minimum of the new technology. And, which is going to win out is going to be, I think, the big theme of the capital markets over the next 20, 30 years. So, I need to pause here just because of the clock, but we have about 20 minutes for Q&A. And who has the mics? So if you have a question, put up your hand and then someone will come to you with a microphone and we'll talk about it. Okay.
Yes, hello, my name is Anders Tagde, KPMG.
Hey,
one of
morning.
the guys who lose my job then, I understand.
Yeah.
So,
it's not personal.
No, it's okay, I understand. So one big thing, I guess, is knowing about this transaction, controlling it in terms of crime, anti-money laundering, those types of things, taxes, whatever.
Yeah.
Of course, that's a big discussion as well.
No, it's...
And perhaps this is not your topic, I don't know, but
No, I have a lot to say on this, actually. Yeah. And it's well known that there are people on the Bitcoin network, including terrorists and Iranians evading sanctions, drug dealers, and so forth. First thing to be clear on is that they use the regular money, too. That these people already had many other channels. And the reason that they use the Bitcoin network is because it's so secure. I think, though, the central bank digital currency idea is really the bullet that will put these people out of business. That if you have the Riksbank, this Federal Reserve, putting all the national economy onto a blockchain, they can collect all the taxes they want. And they can see money laundering in real time. This is actually where I kind of got interested in this, was when Ben Bernanke, the Federal Reserve Chairman, gave an endorsement to Bitcoin. He testified in the U.S. Senate that this was a very interesting technology with a role to play. And I thought, why would the chairman of the Fed endorse something that's designed to put the central bank out of business? And I realized that that's the ultimate customer, that if they had the ledger where all the tax evaders and money launderers were, they could stamp that out really, really quickly. So I think central banks will talk about payments and all these other things, but what they're really interested in is surveillance, and this is the ultimate tool for them. So, stay tuned. There's very interesting privacy questions that come up.
My name is Jörgen Andersson, and I'm in the Committee on Finance in the Swedish Parliament. The obvious questions or thoughts are, of course, what impact it would have once you have a global currency because at some point you have a tipping point, the importance of blockchain global currency. It will severely impact fiscal and monetary policies, and that will have hugely for the world economy and for each country. But also, I have another question. In the early 2000s, the internet companies there were a crisis, and it took almost a decade before they could get back to business, so to speak. And given that the Bitcoin has been changing quite dramatically in the exchange to the existing currencies, what would this mean if it gets? It could make the blockchain technology to get installed, so to speak.
Yeah, these are big questions, and really the first thing you're bringing up is suggesting that something like Bitcoin, maybe Bitcoin itself, would become an international monetary system that would drive out the national currencies. I think theoretically this could happen, but at least for now it seems pretty unlikely. And one reason is exactly what you said, the volatility is very, very high. But ultimately, this is exactly what Nakamoto is trying to do, that you can go back and read his essay and some postings he made on blogs. He has a very libertarian view of economics, and he thinks central banks and governments do much more harm than good when they intervene in the economy. And his vision is very much a 19th century neoclassical one, where money is neutral and governments can't interfere in free exchange. So no one should have any illusion about the implications, and I think you pretty much got them straight on, that they would undercut fiscal and monetary policy severely. I don't think that any of these currencies has been successful enough to be a serious candidate, but I wouldn't rule out the possibility that people will improve on them and that we would face a future where people sort of opt out of the national economic banks and use these international decentralized networks. I don't think there's a way to stop it because these things are not controlled by anybody. They're controlled by equations on decentralized networks. And we're still a long way from this, but anticipating what the problems would be is probably a good idea. And I think for governments, realizing that you're going to have much less control over the economy is something to be thinking about. And so it's good that you're already here. It's nice to see people from national parliaments show up at events like this. And I think that your point about what happened with the dot-com stocks and how there was a huge shakeout, a lot of people think this will happen with the cryptocurrencies. There are 1,100 of them, as I mentioned. Some of them look sketchy and dubious, and the values have run up so much that it's very hard to understand how Bitcoin could really be worth 4,100, and some of the others have sky-high values that just astonishing. So it wouldn't be surprising if the market dropped, although I'm reluctant to predict that. But would it cause the blockchain technology to disappear? I don't think so, because you're seeing so many big companies using it for things like supply chain management and logistics and so forth that are really pretty independent of the value of Ethereum. And I think that the technology is irreversible. It's definitely here to stay. But whether it's going to be used for decentralized payments, I think probably will depend on supply and demand, and there is some vulnerability to crashes in the values of some of these things. We'll have to see. I've been expecting, though, Bitcoin to drop for about 4 years now, and I've been so wrong about this. That I'm glad I never took my own advice and bet against it. That I've learned not to give investment advice, so I'm not going to say that it's going to drop, but it could, and that's about as far as I'm willing to go. Up front here.
Before your talk, we spoke briefly about central banks issuing digital currency, and we got into the issue of privacy, whereby if they have a complete ledger of all transactions, could essentially be a surveillance state. Yeah. So assume that the Swedish Riksbank do issue this e-krona and other central banks follow suit. Mm-hmm. It wouldn't be that different from the current system, of which Bitcoin is a criticism, since if you don't trust the central bank, for example, Argentina or countries where the central banks aren't doing so well, in Sweden they are doing well. Do you think that this problem with privacy as well as trust in the central bank itself is a problem for issuing digital currencies?
Very much so. The power of the central bank on a national blockchain would be enormous. And privacy of data, we talked about defeating money laundering and smuggling and things like this, tax evasion, but this requires the central bank to actually see everybody's economic activity. And you have to think, first of all, about the value of privacy. And in some of these Nordic countries, you guys seem to have gotten over this a long time ago. You have your neighbor's income on the, everyone can look up everything about and you guys seem to be fine with this. So I think other cultures probably adjust. But how powerful you want the government to be is a very interesting question, and it may cause you not to let them adopt this technology. Or if they did, what safeguards you would put in place. One thing that surprises me is that in the U.S., we've been very successful at keeping income tax data from other branches of the government. So the IRS knows everything about everybody's income, but no other branches of the government can get that information. And they've actually been very successful at keeping it secret. I mean, everyone knows even the president's tax returns can't be found by anybody. And I think it's probably possible to put controls in place, but it is a matter of some concern. The central bank that's done the most work on this around the world is the Bank of England. This is a little bit surprising because they're thought to be conservative, but they have this team called the Future of Money that's laid out a whole blueprint for a national blockchain. And Mark Carney, the governor of the bank, has actually been called into Parliament where he's been asked almost exactly the same question. Like, are you trying to give yourself these superpowers to, watch over all the economy? And are you going to do this next week? And they've had to deny that they have any plans to implement that or that they have the authority to do it. They say it's just an idea. So I think it's a very interesting question. And there's huge potential for the central bank to do things like pay negative interest rates, to target policy very precisely to certain regions of the country, but also to target it to politically friendly places, to red districts that voted for Trump or whatever. And would you want them to have that kind of power? I'm not so sure. And this will be a very interesting political discussion, I think, for years to come. And again, it's good to spot these issues early on. The fact that this is even on the agenda, I think, is remarkable. I mean, you think about this one guy, Nakamoto, programming God knows where, and now he's got governments around the world figuring out what are the implications and should we do this or what safeguards. It's a huge achievement to have moved the conversation this much. And I worry about the same things that you do, for sure. Okay. Yeah, Pehr.
I even have a microphone.
Yeah.
This slide up here I can easily understand the business model for the permissioned blockchain, the existing banks, just using this to rationalize, cut staff, back office staff, and make the products cheaper.
Mm-hmm.
What will the business model be for the open blockchain sort of?
Well,
it will be a peer-to-peer world.
It's a peer-to-peer model, and what has happened with
the business model be like?
I'll explain this. That what if you're a genius 19-year-old teenager, and I have a picture of such a person. So this guy's name is Vitalik Buterin, and he started the Ethereum blockchain, which is an open source blockchain. And he reserved for himself some of the tokens. And these now circulate. It's about a $30 billion enterprise, and he owns a couple of percent. And so the business model is very much an entrepreneurial one. In fact, Satoshi Nakamoto is the person who mined the first million or so Bitcoins. And do the math, right? This is a person who owns $4.1 billion worth of Bitcoins. Now, could he ever sell them? I think if he sold even one, it would, and you can see the blockchain. I mean, everyone can see his wallet and so forth. But I think it's very much an entrepreneurial model, that someone starts something with better designs and they reserve a little bit for themselves. And if it does well, this is incentive compatible too. I don't think there's anything wrong with this, but this is essentially the way it's been introduced. These 1,100 currencies that are circulating, how much the founder reserves or what they set it aside for is a key aspect of this. So I'm sure there's people running around Stockholm who have done this, because there are a lot of people who are in this city innovating in this space. Okay, yeah, another question up front here.
Well, since no one asked the question, I figured I should take a second one. Sure. You wrote in your paper here, is Bitcoin a real currency, that the deflationary property of Bitcoin is bad?
Yeah.
You wrote, if Bitcoin becomes wildly successful and displaces sovereign fiat currencies, it would exert a deflationary force in the economy, since the money supply would not increase in concert with economic growth. This situation would require most workers to accept pay cuts every year. But it's a very useful property also to have a deflationary model, since if you have a fixed money supply and then you have GDP growth, then holding Bitcoin would equal to holding a zero-cost index fund. So this is automatic savings for everyone in the world. So that's also, one good feature of this.
Let me explain what the issue is here. That when Nakamoto created the equations of Bitcoin, he stipulated a growth rate at which new Bitcoins would be issued. And this is the same thing that the central bank does in having a rate of money creation. Now, in the case of Bitcoin, the rate of growth is cut in half every 4 years. And eventually it plateaus by the year 2140 to zero. That the supply of Bitcoins is supposed to be fixed forever at 21 million. Now, this is one rule of money creation, but it's very different than most central banks use. That if you look at the classical economic argument for neutral money, what Milton Friedman would have said is that you want money to grow at the rate that GDP grows. So if the economy is growing 2%, money should grow at 2%. And prices theoretically would be stable in a system like that. But if money is essentially growing at zero, but the economy is growing at 3%, everyone would need to take a 3% pay cut. Now, would this work? I think it's really an argument about psychology and behavioral finance. That you'd have to condition people to, like, if you got only a 2% pay cut and everyone else got 3%, that would be a raise. And this would have, people would have to recenter their beliefs. Now, the good news is you have about 120 years to get ready for this. And so maybe gradually people would recenter and reimagine these things. And you're right that you'd have a form of forced savings. These are interesting questions, and they play into a debate about macroeconomics, about whether the central bank should have discretion over monetary policy or whether there should be fixed rules. And if there's a fixed rule, some people have argued it doesn't even matter what the rule is. That if it's fixed and everyone understands it, we can all go against it and arrange our spending and so forth. So I kind of like this as an academic because it sends you back to a lot of the great debates that in macroeconomics, the ship had sailed on some of these a long time ago, but it's brought them back into fashion. I don't know what the right answer is, but I think in the current world, it would be hard to make a system like this work. In the long run, maybe it would. Yes.
Yes, Mia Horna-Wrandsén, CEO here at SNS. You mentioned that the institutions that would be threatened by this development would do their best to get in contact with regulators in order to stop it or at least make it less fast. What's happening on that front in different countries? Do you see that action happening?
Oh, yeah. I mean, there's a ferocious debate going on. In fact, I'll just give you one example. I was supposed to go to China in 2 weeks to talk about initial coin offerings. And what are these initial coin offerings? They've been very hot the last 6 months. These are people essentially starting their own money and auctioning it off, like an IPO. And you might wonder, like, you guys could start SNS coin and start selling it to people. Why would anyone buy this and so forth? And all I can tell you is that people are raising hundreds of millions of dollars. Now, the Chinese have banned these just unilaterally, and they've been very vague about it. If you ask them what is banned, they say things that are illegal or what is banned. And so I was going to go talk about this, and they said, you can't come speak about this. Now, they felt that it was too threatening to have a public discussion about this. But why is it threatening? Because it's the banks in China that are extremely undercapitalized, that are trying very hard to manipulate this discussion. But this is happening back in the U.S. too, that there's ferocious lobbying going on in regulators to try to get them to exclude this stuff, to tax it. In fact, I can't think of any country in the world where you wouldn't see this happening. You can ask the gentleman behind you if he's heard from any banks about whether this stuff should be controlled and regulated. I'd be really surprised if that hadn't occurred yet. So sometimes the evidence is blatantly direct. You may have seen Jamie Dimon from J.P. Morgan about a week ago gave this interview denouncing cryptocurrency, and he said that anyone in the bank would be fired if they handled this. And then within a day, there were about 100 news stories pointing out things that J.P. Morgan is doing all over the place, that he apparently is unaware of. But a lot of it is, very understandable that they understand the threat and are trying very hard to get the regulators to slow it down. And I'll say that the job most threatened by this is very obviously finance professor. If you don't need these bankers and traders anymore, you don't need people to teach them. And I've had this conversation with my own people back in New York. I happen to be the department chair, and I've said, all of you people need to learn what a blockchain is by the end of the summer, and you're all going to start teaching it whether you want to or not, because this is what industry is demanding. But in the long run, we're going to need a lot less professors in the department if there's fewer finance people, or you're going to have to somehow make yourselves relevant in this. And I think the banks are having the same reaction, the accounting firms. And I'm speaking in December at the accounting regulator in the U.S., and they are planning for a blockchain future with no more auditors. And the question is whether the regulator itself then goes out of business. But that's what they've asked me to talk about because they see this coming. And yeah, it's a very interesting time where people have to consider, are we really going to exist? Is there a need for us in the economy 10, 20 years from now? And I think that's a very uncomfortable thing to consider for a lot of people. So I think one more question.
Last question.
Yeah.
A Bitcoin question.
Yeah.
So speaking of China, obviously we talked about they're going to be up to 20 or 21 million Bitcoins that needs to be mined. So do you have any thoughts on the recent inflation of the Bitcoin price? Because it's not really supply and demand as much as there's Chinese, reallocating money with the capital outflow out of China as one of the reasons I've been told.
Yeah.
But
I would call that demand.
Yeah, but
apparently
there's Bitcoin that's turning into Bitcoin Cash, and there's some regulation that just passed. Just your thoughts on this, if any.
Yeah, you just mentioned the third rail, which is Bitcoin Cash, and this is about a 30-minute answer. But people have found ways to create what's called a hard fork on the Bitcoin blockchain, and in my opinion, create value out of thin air. And I'm deeply suspicious, now that it's been done once, there's something new called Bitcoin Gold that's being put out. And I've said to some of my doctoral students, why not do these hard forks every week if you can get away with them? And this is a technical advanced question that I'm not sure anyone knows the answer to, but it does, in my mind, undercut the value of the currency. But it just seems to keep going up. And I think one reason it does go up is people getting capital out of China. There's very real demand for people to get money out of a country that's almost certainly going to collapse financially. And it's just a question of when. And they find Bitcoin convenient for this is not surprising because it's a lot easier to use than the U.S. dollar or any other vehicle that they might have chosen. But, your question deserves a very detailed answer, and I'm still trying to figure it out myself, to be honest. Okay, so I think we're out of time.
We have
thank
run
you
out
all
of
for
time.
coming. And
David, thank you very much.
All right.
For coming.
Thank you.